Real estate, unlike other asset classes, is inherently cyclical. It experiences periods of growth, stagnation, and decline. Understanding these cycles is crucial for investors seeking to maximize returns and minimize risks. This cyclical nature is influenced by several factors, including economic conditions, demographics, interest rates, and government policies. Real estate cycles are not uniform in their duration or intensity. Some cycles are short-lived and mild, while others can last for years and be quite severe. The factors mentioned earlier interact in complex ways, making it difficult to predict the exact timing and magnitude of real estate market swings. Despite this inherent unpredictability, recognizing the cyclical nature of real estate is the first step towards making informed investment decisions. By understanding the cyclical nature of real estate, investors can make more informed decisions. They can identify opportunities to buy low and sell high. They can also mitigate risks by avoiding over-leveraged investments during periods of market exuberance. Ultimately, a sound understanding of real estate cycles empowers investors to navigate market fluctuations with greater confidence. Real estate cycles typically unfold in four distinct phases: expansion, overbuilding, downturn, and recovery. Each phase presents unique characteristics and investment implications. The expansion phase is characterized by robust economic growth, increasing demand for real estate, and rising prices. As demand outstrips supply, developers initiate new projects to capitalize on favorable market conditions. The overbuilding phase emerges when developers, fueled by easy credit and optimistic projections, overestimate future demand. This leads to an oversupply of properties, putting downward pressure on prices. The downturn phase is marked by declining economic activity, job losses, and reduced demand for real estate. Prices fall further as supply overwhelms demand. Investors experience declining returns and, in some cases, face foreclosure. Finally, the recovery phase begins with a stabilization of the economy. Demand for real estate gradually picks up, leading to price stabilization and eventually renewed growth. Several factors contribute to the cyclical nature of real estate. Supply lags, demand volatility, leverage amplification, and behavioral momentum all play a role. Supply lags refer to the time it takes to bring new real estate projects to the market. This lag creates a mismatch between supply and demand, exacerbating market swings. When demand surges, it takes time for developers to respond with new supply, leading to price spikes. Conversely, when demand wanes, the existing oversupply takes time to work its way through the market, prolonging the downturn. Demand volatility, driven by economic conditions, interest rates, and population growth, further contributes to real estate cycles. Strong economic growth fuels demand for housing and commercial space, while recessions can lead to sharp declines. Interest rates impact affordability and investment decisions, influencing demand. Population growth adds to housing demand, while demographic shifts can create regional variations in real estate cycles. Leverage amplification refers to the use of borrowed funds to finance real estate investments. While leverage can magnify returns during upturns, it also amplifies losses during downturns. This can lead to forced selling by over-leveraged investors, further depressing prices. Behavioral momentum, driven by investor psychology, can exacerbate both booms and busts in real estate markets. During periods of rising prices, fear of missing out, or FOMO, can lead to irrational exuberance and speculative buying, driving prices even higher. Conversely, during downturns, fear and panic selling can push prices below their fundamental value. Section 4. Historical examples of real estate cycles. Numerous historical examples illustrate the cyclical nature of real estate. The U.S. housing bubble of the early 2000s, fueled by easy credit and lax lending standards, led to a severe downturn when the bubble burst. Similarly, the Japanese real estate bubble of the 1980s, characterized by excessive speculation and inflated prices, resulted in a prolonged slump when the bubble collapsed. The global financial crisis of 2008, triggered in part by the collapse of the U.S. subprime mortgage market, had a profound impact on real estate markets worldwide. These examples underscore the importance of understanding historical cycles and the factors that contribute to their formation and unraveling. Section 5. Key takeaways for real estate investors. Understanding real estate cycles is crucial for investors seeking to navigate market fluctuations successfully. Investors should be wary of easy credit conditions as they often precede periods of overbuilding and subsequent downturns. Careful analysis of market fundamentals, including supply and demand dynamics, is essential. Considering rental yields and potential for capital appreciation can help investors make informed decisions. Recognizing that real estate cycles are a natural part of the market is essential for maintaining a long-term perspective. Preparing for cycles by diversifying investments, maintaining adequate liquidity, and avoiding excessive leverage can help mitigate risks. By understanding the forces that drive real estate cycles, investors can position themselves to capitalize on opportunities while mitigating potential downsides. Remember, real estate is a cyclical market, and those who understand the cycles are better positioned to succeed.